Welcome back to Trading Hour. Well, as promised, Dhiraj Sachdev, CIO of Roha Ventures, joins us now to discuss market fundamentals and his top sectoral picks. Thank you so much, Dhiraj, for joining us. First up, it's a very volatile market that we're seeing, especially in the past week. How are you looking at markets at the current juncture?
Yeah, hi, good morning. So the Indian equity market is navigating significant volatility, as you rightly mentioned, and this is driven by US policy decisions, elevated bond yields, and a strong dollar, which are impacting FII flows. Now, all eyes will be on the US, especially on the incoming Trump administration's tariff policies. Now, dollar has strengthened in anticipation of pro-growth policies in US, and there is a possible near-term peak that should see pressure on emerging market currencies is also easing. It's also possible that the Trump policies announced may not be as draconian and it will be less stringent as well. So all these are possibilities, while the market is already fearing in advance. However, coming back to India and in the domestic market, there is resilience as the consumption trends are beginning to show some improvement. Recent data from large offline retail stores, QSRs, and the quick commerce platforms reflect a steady uptick in demand. Now, the Capex cycle, both corporate and government-led, which was somewhat lull in the first half, is also expected to pick up, which can be driven by infrastructure, PLI schemes, and green energy initiatives. So on the valuation front, a large section of small and mid-cap stocks appear to be ahead of time when pricing in forward earnings. Now, these elevated valuation is particularly noticed in themes like defense, railways, shipyards, industrial and capital goods, and even niche IT players, despite their recent correction. Besides, even the IPO market is currently driven by optimism with demanding valuations, which often leave little margin of safety. So while there is froth in certain segments of the market and caution is required, we do find stock-specific or bottom-up opportunities across sectors like financials, consumption, real estate, cement, renewables, pharma and healthcare, including some specific companies in agrochemicals and tech staffing businesses. So from a portfolio construction perspective, despite valuation concerns in certain pockets, we believe that we can navigate and construct a well-diversified portfolio of about 25 to 40 companies with earnings visibility or sustainable growth and reasonable valuation. So this is still achievable. The important part is stock-specific rather than blanket sectoral calls. So net-net, I can only say that the market continues to present a mix of investment opportunities and challenges shaped by both global volatility and valuation concerns.
In fact, you spoke about domestic resilience and how the consumption data is picking up, and FMCG has clearly been the sector of the day. You know, we were chatting, Dhiraj, with Vikash Kumar Jain, the India strategist and India head of research at CLSA, and he said that his biggest overweight going into 2025 is consumption. So let's just quickly rewind and listen in to those views.
Biggest overweight is actually staples. So we run a India-focused portfolio, and for the last 4 years, I've tended to completely avoid staples. And this time, at the start of the year, we've actually made staples our biggest overweight, cut our overweight in banks to just above neutral. Staples, I believe that that's really the big sector call, which we have taken very anti-consensus. We believe that the realities of coalition government and the hints that we have got from recent state elections, plus the good rainfall that we've seen and the good sowing that we've seen, maybe just bring back that affordable consumption to kind of life. And within staples, we like the food-related companies more.
Got that. Dhiraj, so in the consumption pack, I know you're not advising that have a blanket sectoral call. It's all about individual stocks, and within every sector, you will have winners and losers. But in consumption, what is it? Are you looking at staples? Will it continue to be the top-end discretionary spending? Is autos a favor? I mean, give us how you should think of looking at consumption and where there is growth and valuations may be reasonable.
The last 6 months have seen a prominent increase in government's willingness to raise spending on welfare schemes, particularly around state elections to attract voters. Now, these, along with a rise in crop sowing plus good rains, should improve rural incomes and help in driving some recovery in affordable consumption. So we're talking about affordable consumption. Now, Q3 results will be muted for staples, though rural has outpaced urban growth, and staples are witnessing slower growth and enhanced competition intensity, resulting in subdued earnings growth. So as a trend, what we have seen in consumption is shrinking product life cycles and premiumization, which will continue to across segments, while mass growth the categories has remained under pressure. So also quick commerce continues to gain traction from general trade. So we like specific opportunities in consumer durables or auto retail or alcohol beverages, QSR, aviation, and domestic apparel when we talk about consumption, where companies are benefiting from wedding season demand or structural shift to organized sector.
Understood that. Another question which you want to ask you is, you are quite optimistic as far as the domestic Capex theme is concerned. While government Capex is expected to pick up in H2, private Capex still seems a while away, and you seem to be quite positive as far as the infra space is concerned, even renewable energy space. What's your view over there? And do you think a lot of stock prices are already building in or pricing in quite a bit of the optimism?
Yeah, you very rightly said. See, after a slow H1 due to election delays and rains dragging execution cycle for capital good companies, they are set for a strong H2 with most companies retaining a yearly guidance. So while earnings growth is likely to be positive, driven by manufacturing and government capex, valuations are stretched and ahead of time for companies in industrials, defense, railways, when we talk about power transmission and distribution or renewable spaces. So one has to elongate the holding period while the earnings growth will be there. It is largely priced in. So one can't expect more, similar kind of returns over the next couple of years or so. One has to moderate the return expectations here.
Banks, a quick word on banks. Traditionally, I mean, consensus is largely still overweight on banks going into this year. But what's your own view? And any sectors to completely avoid?
So, RBI was concerned about high growth in unsecured loans, and while gap was there in loan and deposit growth, in addition to operational gaps in NBFCs, I think that is at the end of 24 may have been addressed with unsecured loan disbursement expected to come down. Besides, bank lending to NBFCs is also slowing, and the loan and deposit growth have started to align. So as a result, we do expect credit growth to be still slower at about 11 to 13% over the next few quarters. So going forward, we do expect that RBI may have 50 basis point of rate cuts to support growth and investment, and pressure in unsecured retail loan is expected to ease. But microfinance will still continue to have pressures, and we need to watch it very closely how the trends will behave on the NPA side. Overall risk reward is favorable with the expectation of easing asset quality pressures in the banking and financial. Our preference here will be housing finance companies due to secured loan book and geographical reach. Sectors to avoid, we still believe some of the companies are ahead in terms of valuations. So in the interim, we are avoiding, though they may have solid earnings growth, whether it is the electronic manufacturing service, EMS kind of companies, or metals, because we still believe that there will be issues, and China stimulus is really not panned out as it is. And the real estate recovery in China calls for caution in the metal sector.
Thank you so much, Dhiraj, for joining us and giving us your take as how exactly you're looking at markets currently.